There's one call on Wall Street that every trader dreads getting. It isn't from a client, nope, not a regulator either. This is the call that can absolutely obliterate a fortune in a heartbeat. And believe it or not, this whole story, it starts with a guy who completely mastered the market, only to have it turn around and destroy him. Just imagine finding this. These are the last, absolutely chilling words from a suicide note discovered in the cloakroom of a fancy Manhattan hotel back in 1940. And the man who wrote them, a true Wall Street legend, a guy who had the markets figured out in a way that almost no one has, before or since. So you have to ask, right? What on earth happened? How do you go from making what would be billions of dollars today to just complete and utter despair? Well, the answer is kind of wild. It's wrapped up in the exact same tool that fueled his incredible rise and also his catastrophic fall. And here's the kicker. That tool is more available to you and me today than it has ever been. Okay, so to really get our heads around Livermore's story and the danger of that one terrifying phone call, we've got to talk about leverage. Think of it like a superpower. It's a force that can build empires out of thin air and, just as fast, turn them into nothing but dust. And you know what? The basic idea here is actually super simple. Let's break it down. A regular cash account, that's basically like your debit card. You can only trade with the money you actually have in the account. Pretty straightforward. But a margin account, well, that's more like your credit card. Your broker is essentially lending you money, letting you play with a much bigger stack of chips than what you brought to the table yourself. So, this whole act of borrowing money to boost your trading power, that's what we call using leverage. It's like a key that can unlock the door to absolutely massive profits. But, and this is a huge but, it's the very same key that can lock you into some truly devastating losses. I mean, just think about how powerful this is. Let's say you have a 100-to-1 leverage ratio. That is insane. It means for every single dollar of your own money, you're controlling $100 in the market. So your little $1,000, it's suddenly controlling a position worth $100,000. The potential to make money is just mind-boggling. But here's the catch, and it is a big one. Leverage doesn't care if you're winning or losing. It's just a giant amplifier. It makes your gains bigger, for sure, but it makes your losses bigger too by the exact same amount. A tiny little market move in your favor could mean a huge payday, but a tiny move against you, oh man, that can lead to a complete and total wipeout. And that massive risk, that's what brings us to the main event, this single most dreaded moment in any trader's life. The phone call that basically screams, hey, all that risk you took, it's coming back to bite you. Hard. We're talking about the margin call. So what is a margin call, really? To put it simply, it's your broker calling you up and saying something like, listen, your trades are going south fast. That little cushion of your own money you put up, it's almost gone. You need to wire us more cash, like right now, to cover these losses, or we're going to have to step in. Okay, so how does this whole nightmare scenario even start? Let's walk through it. Step 1, you use margin, that's borrowed money, to open a trade. Step 2, the market doesn't do what you want. It moves against you. Step 3, the money that's actually yours in the account, your equity, starts to shrink. It drops below this critical safety level that the broker sets, called the maintenance margin. And then, boom. Step 4, your phone rings. You've got the call. And this is the question that probably gives traders nightmares. The market's tanking, your account is getting drained, and your broker is on the phone demanding more cash. So, what happens if you just don't have it? What then? Well, the reality is, it's brutal. The broker doesn't mess around. They don't wait for you. They have the legal right to start selling off your stuff, your stocks, whatever you're holding, immediately to cover what you owe them. They can just liquidate your entire portfolio without even asking you. And they often do it at the worst possible time, right at the bottom of the market. This turns those on-paper losses into very, very real, permanent losses. You've completely lost control. And that brings us right back to Jesse Livermore, the man who lived this terrifying reality more intensely than maybe anyone else in history. I mean, we can talk about the technical details of margin all day, but Livermore's life, man, that shows you the real human drama behind it all. Seriously, Livermore's career was the definition of a roller coaster. Just look at these insane swings. He makes $1 million in a single day during the panic of 1907 and then goes bankrupt. He then makes $100 million during the 1929 crash, only to lose every penny and go bankrupt again just 5 years later. Every single one of those incredible highs was supercharged by leverage, and every single devastating low, that was the direct result of the market turning on him and those dreaded margin calls that always followed. When you get down to it, leverage was both his superpower and his kryptonite. It's as simple as that. The very same tool that made him one of the richest, most legendary traders in the world was the exact same thing that brought him to ruin. Not just once, but over and over again until he just couldn't fight anymore. Livermore's story is, for sure, a cautionary tale, but it's also a really powerful lesson for all of us. We can actually learn from his mistakes. So the big question is, how can traders today use this incredible power of leverage without ending up like he did? All right, so how do you avoid that fate? Luckily, there are some really clear strategies you can use. First off, be smart with leverage. Just because your broker offers you 100 to 1 doesn't mean you should take it. It's crazy. Next, you absolutely have to use stop-loss orders. These are lifesavers. They automatically sell your position if it drops to a certain point, putting a cap on your potential losses. Third, and this is huge, always keep a cash buffer. Don't go all in on your trades. Having that cash reserve can help you survive a downturn or even meet a margin call. Fourth, diversify. You've heard it a million times, don't put all your eggs in one basket. And last but not least, you have to watch your account like a hawk. When you're playing with leverage, you just can't afford to look away. You know, at the end of the day, Jesse Livermore's story isn't just about stocks and trading. It's about that timeless battle between our ambition and the risks we take to achieve it. And leverage, it just puts that whole struggle on hyperdrive. It's an unbelievably powerful tool, there's no doubt about it. But it demands respect. So I guess the real question to leave you with is, how are you going to manage that risk?